Big news coming out from Microsoft. It's reportedly in plans to invest $10 billion in creator of buzzy AI tool ChatGPT, and if you don't know what that is, it's everywhere. So if you go on Twitter, you're gonna see ChatGPT trending all over the place, and really what it is an AI-based tool that you can use for a lot of different things. For example, let's say instead of going to Google and searching, or Bing, for example, talking about Microsoft, what if I went and I said, okay, let's go ahead and say, give me 15 things to do in Singapore in a 2-day period while I'm visiting. It just spits out the things that I wanted to hear about right now. So I don't have to go out and I don't have to go over to Bing. I don't have to go over to Google. I can just type it in here. And so maybe as you can see now, if Microsoft has the power to control ChatGPT, do they maybe have a potential to have a leg up finally on Google? Because let's face it, Google makes hundreds of billions of dollars from advertising via search, right? Searching for things via Google, whereas Bing is not nearly as popular as Google is, but can this change things? So in this video, I'm going to tell you what I think Microsoft is worth. I'm going to give you my price target for the company. And before we do that, we need to go over an amazing visual that I think will help anyone who's starting to invest, anyone who's newer, and even people who've been doing it for a while. I think this visualization is going to help you understand investing better, especially with specific stocks. Now let's talk about Microsoft. So I put this thing together and it takes a long time for me to make these. So I do want you to make sure that you leave me a comment and tell me if you do like these, because I need to know if I should keep making them. The first video I did on Apple, everyone seemed to like it, and so I'm doing it again here. This is the segment of how Microsoft makes money. This is the sales or revenue. This is the total sales of all of the different things. When you combine them, they get to this big green bar. And as you can see, the bar is how big the amount of money is. And so it's a visual representation of everything that we could probably see from the income statement, and I'll show you in a second how this looks. So here we're looking at the income statement of Microsoft, and as you can see here, the total revenue, or we'll call it the total sales of Microsoft, in the third quarter, the past 3 months leading up to the quarter ending in September of 2022, it was $50 billion in revenue. $50,122 million in revenue. That's how much money Microsoft was able to generate in sales in that time. So that $50 billion is right here, $50 billion in sales. So this is the entire income statement visualized for you. So what we can do here is we can say, okay, first off, sales were up, or revenue was up 11% year over year last quarter. And this is how we trace all the way from all of our revenue to where we get to that net profit, the net income part that we want to know, the earnings of the company. And this is the path that happens. So net sales minus the cost of revenue, you get to your gross margin. It's up 9% year over year. You subtract the gross margin from R&D, sales and marketing, general and admin, then you get up 6%, 22 billion income from operations. There's a little other income in here. Don't worry about that, but you subtract this from income tax, and that's where you get your net income of 18 billion for Microsoft last quarter. And we have here, which is what I want to focus on, which is the revenue by segment. And this is how Microsoft makes its money. So server products and cloud services. This is going to be things like Microsoft Azure. So that's like a huge money maker for them. So cloud computing. So we have that. Now that's 37% of their revenue or their sales, right? And it's 18 billion is that part of that last quarter. And then we have Office products. So we have, for example, Microsoft Excel, PowerPoint, the Office suite, cloud services, and that within that, right? So Microsoft Teams is going to go in there. 12 billion, that's 23% of revenue. These two combined are huge parts of the revenue of Microsoft. Then we have Windows is actually down. The revenue's down 6% year over year. 5 billion, it's 11% of revenue. If you're like me, you might have thought that maybe Windows was a huge part of the revenue for Microsoft, but these days it's not. It's all in these two up here. LinkedIn, 4 billion in LinkedIn revenue, up 17% year over year. So they're making some money in LinkedIn. 7% of revenue. Gaming, so Xbox, 4 billion in revenue, 7%. And then we have up 0% year over year. And then we finally have this part that we want to focus on today. Search, news, and advertising. Think Bing. Up 10% over the past year. Okay, that's good. 3 billion, but only 6% of revenue. What if this could grow to something like Google? To put this into perspective, okay, 3 billion from advertising from things like Bing. Where's that from Google? How much do they make? Well, from ads, so Google search and other properties, $148.95 billion comes from that. This is the part that we're talking about here. What if Microsoft could 10x the amount of money that they make, 20x the amount of money they make in revenue, and start competing directly with Google? Could ChatGPT be the answer here? I don't know. What I do know is that we can look into this further and try to maybe like wrap our heads around this. So Mayor Pete here, who's an AI guy, he tweeted this out. He says, once 92 billion in profit plus 13 billion in initial investment are repaid to Microsoft, and once the other venture investors earn 150 billion, all other equity reverts back to OpenAI. So this is the deal, I guess, that's being structured with Microsoft and OpenAI. But here's the other part of this, and a way to look at it. We have economics of OpenAI deal. So basically, it starts with the closed partners. You have 100% of all the money that's made. 75% is going to end up going to Microsoft until the investment is paid back, $13 billion. And then we have the next part 4, OpenAI nonprofit starts getting some money. Part 5, larger share of employees get their money. And then we have the remainder goes to Microsoft. It's fully paid down back to OpenAI once this amount is done. And that's at 90 billion that we just talked about before. So at the end of the day, this is still a bit fuzzy and gray right now, right? So it's hard to really understand and wrap our heads around exactly what's going to happen. So for example, if OpenAI does help Microsoft's Bing, does it have to be direct revenue from OpenAI somehow, or does Bing using OpenAI end up getting Bing all the ad revenue basically? And is that ad revenue actually connected to OpenAI's revenue, right? I don't know the answer to this. These are things you have to figure out going forward. But at the end of the day, 90 billion is a potential amount of money that they could make back from this investment that they're putting into it. Now, another potential great integration here is OpenAI could work with things like PowerPoint, right? It could work with things like Microsoft Excel, with Word, right? So at some point in time, maybe all of these things are going to be integrated with OpenAI. It's just going to make it that much stronger, or at least it's going to hold off other competition in terms of AI from taking customers away from Microsoft. So let's figure out what Microsoft is worth. Let's find the target price. So I'm going to start with fundamentals. I'm going to use a bunch of multiples, see how the mean and the medians are looking going back. So here, for example, this is just the price of Microsoft stock going back for 10 years. So I'm going to go back and let's take a look at the PE ratios going back and the forward PE ratios and how they look. So I'm going to take some of these off real quick so we can see this better. So now we're looking at is the historical price to earnings ratio for Microsoft going back 10 years. So these little lines here, we have the median PE is 28.7. We have the median PE 27.7, and Microsoft is under median and mean PE ratios over the past 10 years. It's at 25.4. So maybe potentially this could be considered cheap if we go back 10 years. Well, if we go back 5, we're still cheap, right? So that's good. So right now we're trying to say, is it potential that we're at a high PE ratio? Is it elevated? Is it maybe too expensive? And it doesn't look like that so far. So we're looking at trailing PE ratios. Let's look at the forecasted PE ratio, and we're going to look here at the next 12 months PE. And so how does this look? This also looks cheap. Median of 28.5, mean of 27.3, and we're sitting now at a 23.9. So also good. This is going back 5 years. We could switch it here to 10, right in the area where you probably are going to be maybe average of what we've been over the past 10 years. Now we're going to look at free cash flow. Free cash flow over the past 10 years, it's a little higher. It's a little elevated in terms of the multiple that we're looking at in terms of the past 10 years mean and median here. So maybe a little high, but let's go back to the 5-year average. Okay, well now we're down, right? And so we're kind of, let's say, I'm going to say that we're maybe in the fair area here. I don't think it's too expensive so far. Next, we want to take a look at margins. So are margins expanding? Are they getting better? Or are they getting worse? Margins are actually, they've gotten better since, the past 5 years, and it's still above the mean and the median. I like that. That's very good. And the same with the past 10 years, it's elevated. So that's good. So that's the net income margin. Let's actually look at the gross profit margin. Same deal. We're looking good. We're looking above the mean and the median for the 10-year. On the 5-year, we're looking good too. We're kind of getting close to that median profit margin over the last 12 months, right? The average profit margin over the past 12 months, gross profit margin, but not too bad. And then we have the last thing we're going to look at here is long-term debt to equity. This is down. It was up as high as 105% back in 2018. This thing has declined rapidly. The debt in this company is way lower than it was back then. That's also a good sign. So far, all those fundamentals we just looked at, they look okay. They don't look too bad. So I'm happy with that. Next thing I want to do is I'm going to do a little valuation. I'm going to start with the EV to EBITDA valuation. I'm going to also do a price to free cash flow and a price to forecasted earnings, and then we're going to see what we get for a target price when we weight those 3 different target prices that we get. So first off, I put some steps here so you have it, and I have the formula here, but I'm not going over this fast. But I do have the first thing we're doing is we're trying to figure out the shares, and I have them buying back some shares 0.5% per year. And then I have EBITDA growth, and we have the different growth periods, and these are the averages and the median. I went with a 14% EBITDA growth over the next 5 years. Next, I have to choose a multiple for my EV to EBITDA multiple. So these are some of the averages and the medians over the past few years. So what do I do? Well, I went with a 16 multiple, and the 16 multiple is actually less than the average and median of these here. Maybe it's not too high. I'm not sure. I mean, time will tell with history, right? But this is how much the stock would be worth today, $248, and it would have a 5.33% upside. And if I held that until 2027, that would be $427 per share as it grows. It would be a 12.66% annual rate of return over that time period. So then I have to ask myself, am I happy with having that type of return? For me, it's getting close, but it's not quite there yet. But let's take a look at some of the other valuation methodologies first before we come to a conclusion. The past 10 years, the earnings have been this, the past 5 this, and the past 1 this. So what I did was I went with actually a 14% growth rate for this one, and that's how I got a $212 price target. Now let's take a look at the free cash flow. Well, if I hold this steady at 11%, which is the past 10 years growth rate for free cash flow, I get $157 per share, so actually a lot lower. This actually gives me a $194 price target for the company. It's a negative 17.93% upside. So basically, not necessarily a stock I would be investing in quite yet. This is what the chart looks like. Of course, it's in a downtrend like most stocks, and what would need to happen is it just continues in this downtrend. If it did, it would eventually hit this 194 price target. If it does break up through this downtrend line, well, it's another story. So thanks for watching. If you want to see a video just like this about Apple stock, click right here. Here's a disclaimer. See you next time.